I know this may sound crazy, but I get a lot of product questions, and quite a few of these are about the available non-QM programs in the market right now. And through these questions, it's been made abundantly clear that there's a ton of you out there who don't know what a non-QM loan is. You're just saying it's non-QM because it's something you're not used to. So when something like that becomes clear, especially when it's something that's pretty easy to explain, it's infographic time. So here we go. A plain, simple, easy to understand infographic showing the different kind of loan programs that there are. Honing in on the top of things is the stuff that you're all familiar with. Conforming loans. These are your conventional and your government. The conventional loans are broken down into 2 buckets, which are Fannie and Freddie. Your government are broken down into 3 buckets, which are FHA, VA, and USDA. Now sure, there's finer details and subsets of all of these levels. But for the sake of what we're looking at here, this is basically all the loan programs you have to choose from. And this definitely encompasses everything that is considered a conforming mortgage loan. Non-conforming is where it gets a little dicey. And a lot of the people that I have asking me about non-QM loans think a loan is non-QM just because it's a big loan amount. Now that makes a loan non-conforming, but it doesn't necessarily make a loan non-QM. So let's look at the bottom half of this infographic to go over the non-conforming stuff. There are 2 types of non-conforming loans: qualified mortgages and non-qualified mortgages. The qualified mortgages, which are non-conforming loans, are basically your standard vanilla jumbo program type of stuff. They're loans that meet all of the ATR-QM rules, but they have higher loan amounts than can be allowed by your conventional conforming loan programs. True non-QM is when you get into non-qualified mortgages. Every non-qualified mortgage is a non-conforming loan, but not every non-conforming loan is non-qualified. As we saw with those jumbos, you can have loans that meet QM standards, but still fall into that greater, larger non-conforming bucket. In non-qualified mortgages, these are the loans that do not meet all of the ATR QM standards. So you're going to be looking at loans with DTIs over 43% that do not receive DU or LP approval. You have your bank statement loans, your DSCR, no income loans for investment properties where you're just qualifying off the cash flow of the subject property, credit challenged borrower loans with short seasoning for bankruptcies, foreclosures, deed in lieu, short sale, things like that. Your interest only loans, terms greater than 30 years. There is the occasional 40-year term that you'll come across out there, and loans with points and fees that add up to more than 3% of the loan amount. Most people who think they have a non-QM loan don't. They usually have a non-conforming loan, but they've been so used to doing conventional and government loans that they have no idea what to do with it. Non-QM has been the buzzword the past few years, so they just figure, I'm gonna see if there's any non-QM programs out there. But don't just jump into buzzwords. Figure out exactly what you're talking about. Because if you have a non-conforming jumbo, your loan program and your pricing, it's gonna look vastly different than if you have a true non-qualified mortgage and you're looking for a non-QM program that can accommodate that. So again, just a quick recap, you have conforming loans, which include conventional and government, and then you have non-conforming loans, which include your QM jumbo and your true non-QM. When you break it down, it's easy to see the differences, and it's really not that hard to understand. I hope this helped you out a little bit and will help you more easily and efficiently communicate what type of loans that you have in the future.